Welcome to the Movie Market Podcast. I'm J.R. Gondeck, and as always, joined by David Sokolovsky. David, let's look into recap a little bit of last year, but I think more importantly, let's look ahead to this year, kind of review the current conditions we're seeing, maybe some positives, negatives, and horizon, how to look to invest in 2025.
Sure. Thanks, Jared. So yeah, don't want to spend a lot of time on 2024, but it was an interesting year and some notable market activity. So for the year, the S&P, really had a very strong year, but driven just by a handful of names and really a very heavy concentration in the tech sector. And if you look at the outperformance of the S&P to the equal weighted index, it really highlights the difference between the broader economy and just a handful of names, like I said, that have been driving the performance. So over the last 2 years, the S&P has had historic outperformance relative to the equal weighted index, coming in at about 30%. And what that does is it really just opens up some opportunities to rebalance. It gives us a little bit of caution as we approach some bubble-like valuations in some of the tech names and creates opportunity for us to find more value-oriented companies. And if you look at last year and think about the interest rate market and where we're going this year, you really had, two parts of the year where in the first part of the year, rates were relatively steady. You had then some rate cuts as we went through the year from the Federal Reserve, but really the intermediate and long-term rates moved significantly higher and continued that trend as we started the year. As far as total bond market performance last year, really not exciting, coming in at about 1%, and really highlights the importance of individual bond selection and really managing the duration so you're not getting overextended. As we look ahead to the economy, JR, and kind of where things are, what are some of the things that you're thinking about providing some opportunity for us? Where are some of the areas that you're concerned?
The big thing, obviously, that's going to be a topic this year is the Fed. Interest rates, inflation. Those are going to be hot topics of the year, overall. And if you look at inflation to start, in general, it's improved from where we were a few years ago, up until, the last few months of last year, right? And if you look at, the increase in all items, kind of the blue chart, the blue line on the chart, you can see the increase of inflation from September to the end of the year. We got a little bit this week of positive inflation. So it was the first 0.2 print, monthly print in a while. So maybe that increasing trend of inflation is slowing. The Fed doesn't seem to be overly concerned. They're pretty confident that inflation will head back to 2% as we go through the year. The markets don't quite believe the Fed, for the first time in a long time that I recall. And when you look at, expectations for when the Fed is going to cut interest rates again this year, like I said, it's the first time I recall where the market is expecting less than the Fed has projected, right? So if you look at what's happened with market expectations, they're only expecting one rate cut, and the first rate cut the market has priced in today is September, whereas the Fed has stated in their last meeting in December that their forecast is 2 rate cuts this year. And obviously, it's going to be very dependent on the labor market, inflation, the economy, everything else. But David, when we kind of look back to the overall economy, there's no reason to be overly concerned, right? GDP is running in 2.5% range for the fourth quarter, and momentum going into this year. It's hard to see, a big drop in economic growth, overall. But thinking at interest rates now, of what's happened, you have this major conundrum as we enter 2025, where the Fed over the last few months has cut interest rates 1%, but intermediate long-term rates have moved up 1%. And again, if you think of the impact of that, it goes across the board, because the majority of investors, companies, you name it, do not borrow at the short-term rate, which the Fed has lowered. Most people borrow at intermediate long-term rates. And you can see on this chart, that the blue line is interest rates short to long-term in August versus yesterday. And you can see the Fed lowered on the left, interest rates 1%. So those fell, but then look at the orange line relative to the blue now, as you look out 10 years and longer, much higher. And again, that's a challenge facing the markets, because in theory, with higher interest rates, valuation should be a little bit less and other impacts. So definitely the Fed interest rates are going to be something to monitor this year.
Yeah, and Jared, if you think about the different markets that this impacts, so as you mentioned, intermediate and long-term rates, the companies do borrow beyond a very short period of time. And also, if you think about just the housing market overall, that's driven heavily by roughly where the 10-year interest rate is. So as that's continued to move higher, you've seen mortgage rates go up since over the last few months, and that could have some headwinds to the housing market as well as other segments of the economy. But short of that, I think, Jared, kind of like you said, the economy looks very strong overall. So if you look at just broader economic data, whether it's, the services growth, it really indicates a strong expansion. If you look at manufacturing, it's still slowing down, but not nearly at the pace that it was. You have job growth both on the ADP side and on the government reports. The government number really beating expectations, ADP coming in slightly below. But again, no massive or no significant signs of layoffs at the moment. We've seen some tech companies talk about performance-based job cuts, but it hasn't really expanded to the broader economy. You have open jobs moving up as far as the total number of open jobs out there has continued to move forward, and executives expect hiring to increase this year because they were kind of in the wait and see scenario last year, seeing what the impact of interest rates are. But now that we've somewhat stabilized, it seems like hiring should be pretty robust. And kind of like you mentioned, fourth quarter GDP estimates, still hovering in that 2.5% range. So just indicating continued economic expansion. So not as much concern on the economic side. The question I think becomes, is a lot of this valuation baked into the market? And are some of these stocks with very high multiples priced to perfection?
Well, and that's the key, David, because I think that's where we enter 2025 is a little bit kind of that chicken and egg. So the economy's in general, pretty strong shape, and momentum is positive going forward. You saw this out of a few of the big bank earnings this week as well, where the optimism, a lot of the big banks are seeing from their clients and businesses out there is very, very positive, at this point. So I think you got to bring it back to valuation, right? And it's the first time I used the word bubble in the last 2 months, in a very long time to kind of describe parts of this market, right? And I think, looking at history, at the late 90s, there was a period of time, 97, 98, 99, where looking at the S&P returns, very, very strong in the late 90s. But again, it was contained to a handful of companies for the most part of the late 90s. If you were in a diversified portfolio, it didn't do nearly as well as being concentrated in the handful of companies that did extremely well in the late 90s, at this point. And thinking about conditions now, this is clearly not a terrible bubble, right? I believe at this point, the economy is very strong. Late 90s, there was so much excess, and the valuations were even higher in parts than they are today. So I don't know that it's a scary bubble building, but the conditions we saw the last 2 months of the year, where there was a huge move out of the majority of stocks into the handful of biggest companies that drove the results, really indicates that there's this separation going on in the markets that's non-sustainable. If you're in a market where everything's rising, but some is rising faster, that's kind of more the normal market. But where you have the majority of the market falling and a few rising, that's what starts to build, in my mind, a little bit of those conditions. And again, as you saw Goldman Sachs, highlighted a few months ago, they see a lost decade ahead. And look what happened, from 99, the end of 99 through 2009. The S&P was down for 10 years. So you had that huge excess of run up of all that optimism, but then it just takes a long period of time to grow into those valuations, at times. And I'm always reminding of Microsoft, right? Microsoft hit 500 billion in 2000, and it was the biggest valuation, the largest company at the time. It took Microsoft 15 years to get back to those valuations. And that's one of the challenges when you talk about chicken and egg. Things are in good shape, but the average PE of the biggest 7 or 8 companies is close to 50. So they're great companies, but you just never know when you're in kind of the excess valuation or bubble conditions, when you need to sell and what you need to do. But I think we're all mindful of the challenge facing some of the higher valuation. And the question, David, is where do you invest? What do you do given, kind of these types of conditions here, short term, looking into this year.
Yeah, so I think as you kind of take a look at the market, just prudent to take some gains to start the year. Lock in some of the strong performance and some of the names that you've owned from the prior year that have done very well, but just to reassess the landscape because a number of things are going to be changing, as we look around. We have an incoming administration, a slightly different interest rate policy than we anticipated last year, and really just a stronger economy overall. So it makes sense to rebalance and find the opportunities in areas where companies just haven't kept up with the broader S&P. So if you look at one particular segment that we like is financials, those should continue to perform well. They have, if you look at asset prices that they manage, if you look at just some of the slower growth ahead, which could lead to M&A or other types of restructuring where they're heavily involved, or just larger companies that maybe not growing at the pace that they would like to and looking to acquire their next leg of growth. So financials really stand to benefit, and really some of the lower PE stocks, more of the value companies stand to benefit because again, if there is somewhat of a downturn or a shift in the momentum of the market, you're going to be looking to rebalance from some of the names that have performed really well, lock in some of those gains, and find opportunities where the growth ahead looks a little bit more promising. And the other area I think that's been very positive and continues to remain strong is the bond market, because again, we're in an environment where interest rates have moved up. You really don't have to take on a lot of additional risk to increase the total return and the yield on your portfolio. So for people retiring these days, it's a much better situation to be in than, let's say, 10 years ago when interest rates were basically zero. And then one of the other opportunities that we're seeing is, and not being very aggressive with this, but slowly extending out duration a little bit to just lock in some of these higher yields for a longer period of time. Because if you do see a slowdown, rates can come down. If you see a number of different things that we look for, it could really drive rates in either direction. But the downside risk, really rates coming down over the long period of time would be something that you want to mitigate and just create some certainty in your portfolio so that you don't have to worry about where the interest rate environment's going if it really ties back to your financial plan.
Well, and David, it's kind of the old saying, how do you make a lot of money is be concentrated in few or one investment and be right. The other side of the coin is how do you lose a lot of money is to be concentrated in a few and be wrong, right? And I think that's the challenge facing a lot of investors is you've done very, very well in these handful of companies, and they're great companies, but how do you protect yourself in a lost decade or slower period? And it's stay diversified, right? There's nothing wrong with these companies. The valuations are high, and it's prudent to take a little bit of profit. Like you said, we're taking, give or take 10%, profit on certain positions to start the year just to rebalance and stay on track. And, the environment has changed a lot. Whereas a few years ago, if you want to be more conservative, interest rate environment was close to zero. And it was very difficult to lock up any safety or protection. And that's not the case in this environment. So, the bond market, as he said, should have another solid year, just given where interest rates are. And for investors looking to protect their portfolios and lock in some gain, you're not putting the money under the mattress, so to speak, earning nothing in this environment. There's pretty decent returns. And then on the other side, like you said, there's a lot of optimism in the mergers and acquisitions. And part of that reason is because of the dispersion of returns. So if I'm one of the biggest companies that have done well, I'm able to buy some of these other companies that haven't done nearly as well at a much cheaper valuation. So you could see how naturally the merger and acquisitions could have a very strong year, is just the relative valuation between the companies that haven't done as well as some of the bigger, on top of interest rates coming down and such. So with that, we're gonna thank you for tuning in to kind of a recap of last year, looking into next year, 2025, and we'll kind of touch base next month to see how the earnings might sway kind of views and where we lean the rest of the year, February and beyond.
Thank you.